Should you fix your mortgage rate now and secure a fixed rate deal, or wait until base rates in the UK fall as the governor of the Bank of England has predicted? That's the burning question on everyone's mind at the moment, and it's perplexing even mortgage brokers who can't really tell you one way or the other. This week, the Bank of England Governor, Andrew Bailey, in an interview with The Guardian, said that the bank would start to cut rates a bit more aggressively, as he calls it, as he should have done maybe 6-9 months ago. So that there is good news on that front. However, they're watching what's going on in the Middle East at the moment, and any escalation of war could push up oil prices, which will have an immediate effect on inflation and could hold out any good news for borrowers of a cut in interest rates. Of course, they cut base rates in August from 5.25 to 5%. Okay, so this is the Bank of England headline here, that they're moving closer to a rate cut. When this is, we don't know. So as you can see, they've said that they cut rates recently, but it was the first time in about 4 years. And so here we go. Bank of England, what will they do? This is the graph of the rates, how they went down after the last financial crash, 2008, 2009. They were cut and stayed very low for 10 years, and it was good news for borrowers, and we all got used to these incredibly low interest rates on buy-to-lets, and that fueled a boom, I guess, in buy-to-lets. But they've started to rise, as you can see here, just in the last year or two, and shot up to 5.25, and have only just started to come down. So that's the story there. But what should you do? Because if you look at some of the rates on offer, they are very expensive for 2-year fixed rates. Now, ideally, I've got a buy-to-let product coming up, and I've looked at this myself recently in October. I had to move lender to get a better deal. And I said, well, what about a 2-year fixed rate? Oh, yeah, we can do this 2-year fixed rate. But look at this, an £11,000 fee, which is ridiculous. So the real rate is more like 10%. But they're offering an initial, headline rate of 3.24. Now that's one of the extreme ones. But even, look at these banks. It's £7,000 fee for a 2-year fixed rate, a 1-year fixed rate here, but that's got a £3,000 fee, so that the effective rate there is 9%. That's what you've got to look at. You've got to look at a full quote and see what the overall cost is. Then we've got 5-year fixed rates, on the other hand, look better. So this is a 5-year deal. I think it's a buy-to-let, Birmingham Midshires. Yeah, 3.68, quite a good rate. Yeah, a bit of a hefty fee, but then you'd have to worry about it for 5 years. But look, still the rate, the APRC, the effective rate is still 7.6%. And there are deals out there without big fees on a 5-year, if you're going up to sort of 5% and that sort of thing. But what it seems as though what they're saying is, we'll give you a better deal for fixing for 5 years than you can for a 2-year. So they're hedging their bets. They know that probably rates will come down, so they like to lock you into a 5-year deal rather than give you a 2-year deal that you will then remortgage in a couple of years, possibly. So that's the dilemma for a lot of borrowers at the moment. I'm just scrolling down here to see if we can find any more reasonable fees, but they're all hefty fees, as you can see. I was offered a deal for 5 years at around about just over 5%, but the 2-year deal was lower, but then there was a fee of £7,000 on top. So this is a 5-year fix, but I believe that rates will come down. So I would have preferred a 2-year deal and then switch out of that after 2 years. But that's the way it goes. There is an advantage for fixing for 5 years. However, there's one other thing you've got to consider, is the hassle of it, changing mortgage lenders and this sort of thing at the end of 2 years, and the cost of it, possible valuations, legal fees, further fees, arrangement fees. They all charge these rip-off arrangement fees, and maybe even a broker fee. And if you have to keep doing that every 2 years, it can be expensive and difficult. In fact, for me, there was so many questions asked by lenders now, which should be a simple, look, I've got this property, there's plenty of equity in it, the rent's been paid, everything's fine, no poor credit history or anything like that, no arrears. let's just switch it from this to this. But no, it's not like that. There's an incredible amount of questions, and sometimes silly, idiotic questions in my opinion. You just wouldn't believe it, that the hassle of it. So there you go. That's the problem for most people. So what do you do? Well, obviously the choice has got to be yours, hasn't it? You can't just say, well, I'll just do this or that. You've got to weigh up the pros and cons of these deals. I just want to show you about the APRC. Is designed to show that the total yearly cost of a mortgage stated as a percentage of the loan. It's calculated by taking into account the mortgage interest and the term of your mortgage plus any fees. Okay, so that's the choice for you guys. What do you do? Talk to an independent broker that has a whole of market view on the mortgage deals, and then always compare the overall cost. Don't just look at the headline rate and then the fee. Most people say, yeah, we can just add the fee on. That's no problem. Add on £5,000 to my mortgage. But then that's obviously it's increasing your mortgage, but then you're paying interest on that £5,000. So you've got to look at the overall cost. And that's in the proper quote that they should be giving you, showing what is the overall cost over 2 years. Or you can calculate it yourself and say, what is the payment over 2 years plus the fee, and compare it to, say, the 5-year deal. Now, the problem is if you don't choose either, then you'll go onto the lender variable rate, which can be as high as 7 or 8%. So for people coming up to an end of a deal at the moment, end of an era, if you like, they've come off a low rate deal, say 2 or 5%, 5-year fixed, and the lender will say, right, well, you can have this rate, or you can go on to the variable rate, which is 7 or 8% in some cases. So a real sort of rip-off rate. It's well over 2% over the base rate. And that could be a killer. So if you go onto the variable rate, so, well, I'll just wait and see what happens. How long will that go on for? Yeah, the Bank of England might cut rates in November, but what if they don't? What if they don't cut rates till January or February? What if this war escalates and oil prices go up, inflation goes up, and everyone's in a panic? That the Bank of England might say, oh, no, we're not going to cut rates now. We're going to leave them as they are. And in the meantime, you're paying, 3-4% more than you would pay on a fixed rate if you go for a variable. And that can outweigh any savings that you might get by waiting. Do you see what I mean? So we're all between a rock and a hard place, and the lenders have got us like that. If you want this, yeah, you can have that. It's a big fee. If you want this one, well, we're going to fix you in for 5 years. Or if you want a variable rate, yeah, have a variable rate. Stay on that rate as long as you like, because we're getting 7 or 8% off of you. So they win whatever happens. One way or the other, they're going to win. So it is a difficult decision. Talk to an independent financial advisor or an independent mortgage broker, and then make your decisions. What I've decided to do is just fix it for 5 years. And then I'd have to worry about it for that length of time. But it is difficult because certainly my payments on some of these deals doubled. So that's a bit of a killer. And then the other problem I'm talking about landlords here. Obviously for householders, yeah, it's been a real pain, and with bills going up as well, and then the winter price cap, the energy price cap also being withdrawn and adding 10% to your bills as well. And we know the cost of living is a lot more. The real rate of inflation is a lot higher than 2%. So we know this, but for landlords, they've got the additional problems of further regulation, of Section 24, which George Osborne brought in, which means that any landlords with buy-to-let properties in their own name is now that they cannot offset the mortgage interest against the rent, which is business. That's in any business you can do that. You can offset the cost of borrowing against your turnover, which is your rent. So because you can't do that, you could be, especially, and this could push you into higher rates of tax, or maybe you're already paying higher rates of tax on your jobs, and it means that it kind of wipes out any sort of rental profit that you might have got. And a lot of landlords are in sort of negative rental territory where they're having to fund their buy-to-lets because they're not making any money out of it. If your properties are in a limited company, you're okay. You can still offset the interest against your mortgage. But then there's a process to get your property from your own name into a limited company in order to avoid paying capital gains. And I have a firm of accountants that do help people with that. So if you're interested in that, just drop me a line. I'll introduce you to them. But it's another hassle that landlords don't need. And this is why maybe up to 100,000 landlords have already quit, and many more landlords are telling me that they're selling up. In my comments on YouTube, they're telling me I'm just selling up, I'm walking away, and they're just suffering the tax and walking away. Of course, we've got a budget coming up, and capital gains is bound to be increased. The capital gains tax rate is bound to be increased. So a lot of people are selling properties fast, and they're trying to exchange contracts before the budget, which would effectively lock in the rules at that time, the capital gains rates at that time, and then get out while the going is reasonably good. But still, you've still got to pay a hefty amount of tax. Some landlords take the view that, look, if we put it into a limited company and then never sell it, just pass it on to their children, which you can do more easily in a limited company. You can assign them shares, use trusts and that sort of thing to pass it on to your children. So the property may never be sold. And if you can avoid some of the inheritance tax, but with good planning, you may not have to suffer these taxes. The capital gains tax is only triggered when you have this taxable event, like you've sold the property or you give it away or something. Yeah, that will trigger that tax. So if you can avoid doing that and just say, well, I'm going to just keep this property forever, like the Duke of Westminster does, and all these big landed gentry that own most of London, the freeholds anyway, they're not selling. They're not going to say, oh, Keir Starmer's coming, we're all about to sell. They will pass that on through the generations to come and keep their properties in the family for hundreds and hundreds of years by the use of trusts and companies and proper will planning. So that's vitally important if you're a landlord. And as my friend says, if you love your children more than you do the tax man, this is what you've got to do. You've got to plan for the succession, for the legacy, so that you can pass on your property intact. And I think that's right. I think that's fair. I know a lot of people on the left, on the socialists, say, no, it shouldn't be passed on to the children. You should pay inheritance tax, and we should increase inheritance tax, which I think they're going to do, and then pass it on to the state and let the state spend your money. No, I would rather be able to pass on my property and my wealth to whoever I want to, not who they say. And I'd rather do it without paying too much tax, legally, of course, if I can do it. So thanks very much for listening. I know that I know I haven't given you any definite fix or stay or put, but you've got to make your own decisions. But I hope I've given you some options there to help you make the right decisions. So thanks very much for listening, and I will see you on the next episode. Thank you.